Welcome to Talk Tickers. So Ascent Industries just dropped an earnings report that, well, on the surface, makes absolutely no sense. You've got revenue falling off a cliff, but at the same time, their profitability is skyrocketing. In this explainer, we're going to dig right into their Q2 2025 earnings call and figure out what's really going on at this critical turning point for the company.
Okay, so let's just break this down. This quarter was a real tale of two tapes. In one corner, you've got the bad news, a clear miss. Revenue was down 13% from last year, and they posted a GAAP loss of 25 cents a share. But in the other corner, you have this massive beat on what really matters for the future. Gross margins exploded, up almost 1,300 basis points, and they bought back a huge chunk of their own stock, nearly 6% of the entire company. It's a total head-scratcher.
So with all that conflicting information, how did the market react? Well, it kind of shrugged. The stock barely moved, dipping less than 1%. And that tells you everything. The street is basically saying, okay, the headline numbers look pretty ugly, but we see that you're making some real progress under the hood.
And to really get that progress, you have to understand the backstory. See, these confusing numbers aren't a mistake. They're actually the whole point. This is the messy but planned result of a huge corporate transformation. Ascent has been pivoting away from what it used to be. And this quarter, well, this was the grand finale.
This pivot really came to a head in Q2. They basically cleaned house. They sold off their BRISMET business for $45 million in cash, then closed the sale of ASTI for another $16 million right at the end of June. And just like that, the old low-margin tubulars business is officially in the rearview mirror. As a cherry on top, they even got added to the Russell 2000 index, which is a pretty big deal.
And you don't have to take my word for it. The CEO, Brian Kitchen, put it about as bluntly as you can on the call. He said, "Our portfolio is clean, our focus is singular. Ascent is officially a pure-play specialty chemical company." That's not just corporate speak. That is a flag in the ground declaring that a whole new chapter for this company has started.
Okay, so they've gotten rid of the old business, but where's the proof that the new business is any better? Well, you find it in the margins. This is the absolute core of the bull case for Ascent right now, and honestly, it's where the story gets really, really interesting.
The number you need to burn into your brain is 26.1%. That was their gross margin this quarter. For a specialty chemical company, that is a fantastic number. And for Ascent specifically, it's a massive leap forward.
And look, this wasn't some one-time fluke. The trend is undeniable. A year ago, they were at just 13%. Last quarter, it was 17%. Now, over 26%. That's not an accident. That's a deliberate strategy paying off. Management is pointing right at this chart as proof that their new business model is just fundamentally stronger.
So the big question is, how'd they pull it off? Well, it was a multi-front attack. They got smarter about where they bought their raw materials, they shifted their sales mix to more profitable products, they kept a tight lid on costs, and they were strategic about their pricing. It's just solid operational execution, plain and simple.
Now, we do have to add one little asterisk here, and full credit to the CFO for being upfront about this on the call. About $1.2 million in costs got moved from one accounting bucket to another, which made that gross margin number look a little bit better than it was. But, and this is the key part, even if you adjust for that, the underlying trend of margin expansion is still absolutely there. It's real.
All right, that margin story is pretty compelling, but it is not all sunshine and roses. So let's pivot and do a little reality check, because you've got this battle between some real headwinds and a seriously strong balance sheet. So on the negative side, yeah, they're still posting a GAAP loss. A big chunk of that is due to this idle Munhall facility. It's basically a piece of the old business that's still acting like an anchor, dragging down earnings by over $2 million a year. On top of that, the broader economy for chemicals isn't exactly booming right now.
But, and this is a huge but, here's the counterargument. They are sitting on a fortress of a balance sheet. We're talking over $60 million in cash, zero debt on their credit line, and more they can tap if they need it. And they're using that cash firepower too, buying back a massive chunk of their own company. That kind of financial strength gives them a ton of flexibility to weather any storm.
Okay, so that's the story of the quarter. Now let's put it all together and look forward. What should we expect on the next earnings call? Here's our take. So you've got this complete transformation. The battle lines are drawn, right? It's weak revenue versus strong margins. It's this operational drag versus a rock-solid balance sheet. And that leads us to the million-dollar question for anyone looking at this stock. Where does it go from here?
Here's our thesis. We're calling it the messy pivot. We think the market is still stuck looking in the rearview mirror. It sees the messy revenue number, it sees the GAAP loss, and it's hesitant. The trade, in our view, is betting that eventually the market will catch up and start valuing Ascent based on the new, much higher quality earnings of this focused chemical business.
So let's get specific. Over the next couple of quarters, we're watching for two things: signs that revenue is finally stabilizing and proof they can keep those margins strong. Any news on that Munhall facility would be a bonus. Our prediction? Management is going to talk a lot about their new $25 million business pipeline. We think they'll get back to positive adjusted EBITDA if you ignore the Munhall drag. But for the stock to really move, the market needs to see one thing: real, actual organic growth.
And all of that brings us to our final rating, market perform. Look, the transformation they pulled off is super impressive, and that margin story is legit. But with the economy still a little soft and the top line still shrinking, we think the stock is probably going to tread water and perform in line with the market, at least until the company can truly prove its new growth story.
Ascent has done the really hard part. They've rebuilt the entire company. Now comes the prove it part, showing they can grow. And as always, please remember, this is not financial advice.